So people always ask us, if we only had $1,000 to invest, how would we invest it?
In this video, we're going to walk through exactly how we would invest $1,000 in the stock market. Subscribe to our channel so that you don't miss out on our new videos every Monday at 6 p.m.
In order to actually invest $1,000 in the stocks that we'll talk about today, you'll need the ability to buy fractional shares. And lucky for you, there's now multiple brokerages that allow you to do that. And here are a few of them: Charles Schwab, Fidelity Investments, Interactive Brokers, Robinhood, TD Ameritrade, E-Trade, Merrill Edge, and Vanguard. And we can say that we've personally used Interactive Brokers and Robinhood and also Charles Schwab to buy fractional shares. Okay, now we're going to take a look at the stocks that we're going to invest in.
The first one we have here is Meta Platforms, and they develop products that enable people to connect and share with friends and family through mobile devices, personal computers, virtual reality headsets, and in-home devices worldwide.
And if you look at the snowflake analysis on the right, you'll see that they're looking very good on health, past performance, and value.
This on a blaze, feeling good, a little bird on my way. The way them people all around, feeling good, in the place. Not space get bad, mind not getting tricky, getting good day. We come to wine, come to wear, come to mash up the place.
Now let's take a look at their 1-year chart for Facebook/Meta is their new name, which we're gonna all have to get used to. So you can see in the past year, the stock is down 24%. And I also wanted to point out that from their previous all-time high, they're down a whopping 47%. Now let's talk about the pros for Facebook Meta. They have a wide economic moat, which we love, and that's something that Warren Buffett looks for as well. They have a sufficient margin of safety now that they've plunged 47% from their previous all-time high. They have a 12% debt to equity ratio, and we look for that to be below 40%, so check, they've met that requirement for us. They have a 16% long-term growth, and they have a 31% return on common equity. And this is what their leadership invests in, and that's the rate of return that their leadership team is getting from the money that they have. They also have a 17.31 forward PE ratio, which is great. And we also really like the metaverse investments that they're making and the prospect that that has. We believe they're going to be a leader in that space.
So now the cons of Facebook or Meta. They have a 56% 5-year return, and that might seem like a high amount. 56%, that sounds good, but just with the overall for 5 years, it's not necessarily, and compared to the other ones, It's not necessarily high, it's a little low. They have rebranding risk with their name change, obviously. Yep. Data privacy, and there's other issues too. So the second stock we have here is Alibaba, and they provide technology infrastructure and marketing reach to merchants, brands, and retailers to engage with their users and customers in China and other countries.
They're very similar to the Amazon in the US. Yeah. And if we look at their snowflake analysis, you can see that they look really good on the health side, future performance, and value.
To encourage consumers to adopt a more sustainable lifestyle, Alibaba is using the enormous attention it draws on Double 11 to spotlight energy-efficient appliances, organic foods, and even fuel-saving cars. Consumers can use special coupons to purchase these environmental-friendly products. But a big part of Double 11 shopping is discovery, seeing what's new and special for the shopping festival.
Now, if you look at Alibaba's 1-year chart, you can see that it's been a particularly rough year for Alibaba. They're down almost 56% on the year, and they've had some rough times. But the nice thing about that is that it's also opened up opportunities for people to invest and to buy. So here's some of the pros for Alibaba. They have a wide economic moat. They have a 19% debt to equity ratio, a 14% return on common equity, a 14.94 forward PE ratio, an adequate margin of safety given their big price drop recently. They are currently undervalued, and they have built-in diversification just given all the different facets to their business, similar to Amazon.
The cons you can see here for Alibaba are the Chinese government risk associated with that company, since they are a Chinese company, 24% 5-year return, the 5% long-term growth, and there's a rising competition with those different types of companies. So the third stock we have here that we would invest in with $1,000 is Berkshire Hathaway, and they engage in the insurance, freight, rail, transportation, and utility businesses worldwide.
And if you look at the snowflake analysis, you can see that the value is looking a little low at the current point, but they do look great from a past performance and health perspective right now. So for Berkshire Hathaway, we wanted to show a fancy trailer similar to some of the other companies that will look really good, or maybe we could show you their website. But unfortunately, all that's pretty basic stuff, and they don't really have a lot of branding around Berkshire Hathaway, the parent company. Each of the brands that they own and the companies that they own, they have branding.
Right.
But if you want to get a good laugh, go to their website, and you will think that you're not on a legitimate website because it's just so basic. Looks like it's about a 30-year-old website, which I think speaks to actually why this is such a good investment, because Warren Buffett is the founder of this company, and he is, I believe he's 95, he's in his 90s for sure. And then Charlie Munger is his right-hand man, and he's also in his, I think he's late 90s even. And Berkshire Hathaway owns several different companies, some of those being Geico, Shaw, Fruit of the Loom, BNSF, Clayton Homes. So they own those companies outright, and they have, hundreds of, 107,000 almost different employees across the different companies that they own. And then they also have ownership stakes in companies like Apple, Wells Fargo, Kraft Heinz, Bank of America, Coca-Cola, American Express, and the list goes on. Like we said, it's a very well-diversified company in itself, and they own a number of individual companies outright, and then they have investments in the companies that we own. Right. So it's a very interesting company, especially with their large stake in Apple. So this one should be on the top of your list, and it definitely is a major investment for us. So let's look at Berkshire Hathaway's one-year chart. And unlike some of the others, and given the current state of the market being down so much, it's pretty amazing that Berkshire Hathaway is actually up 28%. Right, it's in the green. Yeah, that's amazing. So that chart is looking pretty good considering all the volatility in the market and everything that's going on right now with interest rates rising, the war with Russia and Ukraine. Yeah. So here's some of the pros for Berkshire Hathaway. They have a wide economic moat, 24% debt to equity ratio, 12% long-term growth, 8.8% PE ratio, which is amazing. Built-in diversification like we talked about, 19% return on common equity, and they have Warren Buffett and Charlie Munger leading the way, and they've been with that company since its inception. They've got just a ton of experience, and they're some of the greatest investors of all time. Also with Berkshire Hathaway, I forgot to list it here, but I think their overall return on investment or return over the whole history of Berkshire Hathaway is like 20%. Wow. So that's amazing. Pretty solid. Very consistently beating the S&P 500. Right. And just consistent returns from this company.
The cons for Berkshire Hathaway are Warren Buffett's age and Charlie Munger's age, like we've mentioned before. And then they have 41% allocation to Apple.
Yeah, which sounds great, but then again, it is for a very high allocation to Apple. So if that company goes down, Berkshire Hathaway stock would take a hit.
The next stock that we have here is Trex. And Trex manufactures and distributes wood and plastic composite products for residential decking and railing applications in the United States.
And if you look at the snowflake analysis, you can see that they look great on health and also future performance. Don't ever let them go, 'cause it's the little things. And if you look at the one-year chart for Trex, you can see that the stock is down almost a little over 17% for the year. And you can see that there's been a pretty good downturn just recently, and that's actually been an opportunity for us to buy.
Yeah, we've been watching it for a long time.
Yeah, we've been watching it for a long time, and it doesn't go down very far, very often. So we were actually kind of relieved to see that, and we believe this is a great opportunity for everyone else to buy too. Mm-hmm. Some of the pros for Trex are they have a wide economic moat. I hope you guys are getting the theme that we like companies with wide economic moats, and so does Warren Buffett and value investors. So that's typically on our list. They also have an 18% 5-year growth. They have a 5% debt to equity ratio, so that's very low. And they have a 36% return on common equity. And we've used these products firsthand. We've used them in multiple houses, and we're familiar with them. I also used to work at Lowe's back in the day, and so I got to get pretty familiar with it back then and sold it to people as well.
With Trex, the cons that you can see here are that it has a 60 PE ratio, and again, we look for a 15 PE ratio. So if you look at those two numbers, it definitely is more expensive than what we would like it to be. And it lacks a margin of safety. Again, like thinking back to what we've talked about before, the margin of safety is that area that we want it to get to, that 30 to 40% drop. And again, like with Trex, they're just not there yet.
Right. Yeah. Which like right now, it seems like a great opportunity where it's down 17, 20%.
Right. The next stock that we would invest in with $1,000 is Alphabet. And Alphabet provides online advertising services in the US, Europe, the Middle East, Africa, the Asia Pacific, Canada, and Latin America.
And if you look at the snowflake analysis, you can see that Google's looking pretty good on the value side, past performance, and health.
Welcome to Google TV. The entertainment you love with a little help from Google. Now, all your favorites are organized just for you. Finally. So you can jump back in, watch what's happening live, go sports, or discover something new.
And Alphabet's 1-year chart is also looking pretty good, which is unique in the current market with the current volatility and everything. They're up 24% over the past year. So let's talk about some of the pros of Alphabet. First of all, just the fact that even if you only have $1,000, that you could buy fractional shares of a company like Alphabet and have that in your small portfolio, I think that's pretty amazing.
Yeah.
And there's been so many times that people will come up to us and say, hey, how should I invest? Maybe it's $500, maybe it's $100, and they always assume that they can only buy a small pool of stocks. And I always tell them that, hey, there are fractional shares out there. So actually you can have a really strong portfolio no matter just about how much money you have.
Right.
So don't think that a company like Alphabet, even though
let
it costs...
that $2,600 scare you.
Yeah, and the same thing with Amazon and some of the others that we'll talk about.
Right.
So going back to the pros for Alphabet, a wide economic moat once again. A 19% 5-year growth, 11% debt to equity ratio. Again, that's fantastic. That speaks to the stability of the company and how well they could weather a storm like the one that might be happening now or future stock market crashes, things like that. They have a 220% 5-year return, and we're familiar with the products and services. I'm sure a lot of you guys are familiar with them, so that gives everybody a comfort level. That also has built-in diversification with all the different types of products and services that Google has out there.
Yeah. And the one con that we have here for Alphabet or Google is that it actually lacks a margin of safety. And again, that just speaks to that area that we want it to get to, and it's just not there yet, as you can kind of tell from the chart.
So for us, we have started a position in Alphabet, but it's one of our smaller positions just because it hasn't gotten to that margin of safety level that we'd really like to see to go in big.
The next one that we have here is Adobe, and they operate as a diversified software company worldwide. And you guys know the products. It's the Adobe Creative Cloud with Photoshop, Lightroom, After Effects, even the Adobe Reader. You have your Adobe PDFs.
Yeah, even Adobe Premiere, which is what we use to make our videos right now that you guys are watching. The snowflake analysis on the right, you can see that Adobe looks strong on future growth, value, past performance, and health, especially health.
For me, creativity starts with what ifs. Like, what if it takes place in a white void? Or maybe beige? No, black. What if there's fire? Did that already. What if there are some old cars? Or not? Let's see that in slow motion. Yeah, it's too much.
And for Adobe's 1-year chart, you can see that the company's held up pretty well. In the current market environment, it's down 8.5%, which isn't too bad. But you can tell that they're currently in a downtrend, and we'll have to see sort of how that pans out. Here are a few pros for Adobe. They have a wide economic moat, a 17% 5-year growth, 32% debt to equity ratio. This one's higher than most, but almost a 1,300% 10-year return.
Wow.
And like we said, I know, that's pretty amazing. I wish we had been invested in that from the start, but unfortunately we weren't. Like we said, we mentioned some of the products that they have, and we're personally familiar with those products. We've used a lot of those in our careers and personally, and to do our YouTube channel.
And Adobe cons, you can see here, it has a 44 PE ratio. And again, we want that to be about a 15. That's where we would like it to be. It has future competitors, and it is less diversified if you just think about just the limitations on the products that it has compared to like a Google or
yeah, I mean, there's a lot of different great software that it offers, but it's pretty much in the software category, and it doesn't have that same kind of diversification like you said.
The next stock that we have here is Salesforce, and they develop enterprise cloud computing solutions with a focus on customer relationship management worldwide.
And if you look at the snowflake analysis, you can see that they look great from a health perspective, and then also getting a little better on the value and future performance.
Business is changing fast. In this digital age, everyone and everything is connected, transforming the way we interact with our customers. Salesforce makes easy-to-use, cloud-based business applications that help you stay connected to your customers, prospects, partners, and more.
And if you look at Salesforce 1-year chart, you can see that the company is down almost 20% in the last year, and they've especially been in a downtrend for the last few months. Let's talk about some of the pros for Salesforce. They have a wide economic moat, a 21% 5-year growth, 28% debt to equity ratio, a 791% 10-year return, which is great. Similar to the other companies, we are familiar with these products, and if you were going to invest in this company, we would recommend that you make sure that you're familiar with the products and the services that any of the companies you invest in offer.
Right. Salesforce, on the other hand, has a 62 PE ratio. There is competition out there, and Jared kind of knows that firsthand because he had to go up against them with trying to create a product.
There's a ton of, as far as in the CRM space, there's a ton of other software packages that compete against Salesforce. I think they have the competitive advantage right now, but there are a lot of other CRM systems out there that big corporations can choose to adopt, you know, if they need to.
Right. And along with that, it just has a rigid, complex software. And again, Jared can attest to that because he's actually dove into it.
Yeah, it seems like Salesforce, although they're rigid and complex in the software, it seems to work well for big corporations. But then when you get into the middle and smaller tier, it becomes too expensive, it's not flexible enough, and it's too complicated for some of the smaller companies to understand and to adopt into their company.
And we all know the next one. It's Disney. And the Walt Disney Company operates as an entertainment company worldwide.
And if you look at the snowflake analysis, I wouldn't say they really stand out in any particular category, but they're looking the best in the future growth and health. And for Disney's 1-year chart, you can see that they're down 18%, but I'd say they've held up relatively well, and it's kind of a flat looking chart at this point. So let's talk about some of the pros for Disney. They have a wide economic moat, a 309% 10-year return, a 40% 5-year growth, which is one of the higher numbers that we've talked about as far as growth today. They own Star Wars and Marvel, in case you weren't aware of that. They also own the Disney theme parks, and they own Disney Plus, a way for them to create content specifically for Disney Plus members. And we've been the recipients of that, which is pretty awesome.
Yeah. And then with Disney, you can see here, there's the future competitors. And again, with the streaming service, it just seems like everyone. The pandemic vulnerabilities we've seen just with the potential for the closing of the parks and, you know, what does that look like in the future? And again, like we said before, those competing streaming services that we mentioned. The next one we have is Microsoft, and the Microsoft Corporation develops, licenses, and supports software, services, devices, and solutions worldwide.
And if you look at the snowflake analysis, this is one of the most well-rounded green snowflakes, as Simply Wall Street calls it. So this is just a very well-rounded company, as you probably all would have guessed. They're particularly strong in the past performance, health. They do offer a dividend, which is great for a growth company like this, and not too bad on the value and future growth side either.
Consider us a collective of designers.
Being able to work anywhere is important, especially now.
With Windows 11, we all do different things. Nias is doing illustration.
What's awesome is to be able to combine your fingers in the pad.
If we take a look at Microsoft's 1-year chart, you can see that they are one of the rare companies that is up so far in the past year, and they're up 22%. Some of the pros for Microsoft include a wide economic moat, once again, 1,262% 10-year return, which is one of the higher ones, that we talked about. It was founded by Bill Gates. The Windows operating system is on just about every PC out there. They also have Office 365 is now cloud-based, and I think that was a great move for them to get that out of the software and the old DVDs. And they also have Azure Cloud. They're making a big push on their cloud services and cloud hosting. Another thing is we're also invested in Activision Blizzard, and I may or may not have played WoW, World of Warcraft.
And it was called Burning Beast.
Yes, I did highlight that in one of our previous
in the
metaverse video. Microsoft did, I don't think it's complete yet, it's not finalized, but they did make an offer to purchase Activision Blizzard, and we believe that was a great move on their part, especially for the prospect of the metaverse and just to own a bigger piece of that video gaming industry along with the Xbox.
Now, if you look at the cons for Microsoft, there are future competitors, again, like we've mentioned before, the past competitors, and then just looking into the future of all these companies that are making either new software or they're diving into the metaverse. They have outdated software, and then there's also the antitrust laws. So the next stock, we all know it, probably all use it,
Yeah.
is Amazon. And they engage in the retail sale of consumer products and subscriptions in North America and internationally.
And if you look at the snowflake analysis, you can see that they look very strong in the future performance, past performance, and health.
It's like she can read your mind.
I'm thinking I should get a spray tan, you know, because that's on Wednesday.
Activating blender.
Funeral's on Monday.
Scarlett, this bread is delicious. Did you make it?
Yes, it's from my Gammy's recipe.
Announcement. Gammy is short for she bought it at Whole Foods. Announcement. Colin left the oysters in the car for 5 hours.
It's probably better Alexa can't read your mind.
Bad idea.
What's the game?
Amazon's 1 year chart is looking actually pretty good considering everything we've been talking about. They're down 7% over the past 1 year, and I'd say that's pretty good. They've been in sort of a trading range for quite a while now. Some of the pros for Amazon include our favorite, the wide economic moat, 27% 5-year growth, which is pretty high. Almost a 1,600% 10-year return.
That's the largest.
Yep. I know many of us are familiar with their products and services, which is great. They're also pushing their cloud platform, which is AWS Cloud. And they also have, in our opinion and many others, I mean, some of the best customer service out there.
Never experienced it. It makes it so easy. So now there are some cons with Amazon, even though we think it's this great company, which it is. It has a 47 PE ratio. It does have a 101% debt to equity ratio.
A little higher debt than
a little
we
higher,
would like.
And there are the future competitors like we've mentioned before. The next stock that we would invest in if we had $1,000 is Nvidia, and they operate as a visual computing company worldwide.
If you look at the snowflake analysis, they look pretty good on the future performance and great for past performance and health.
This is beyond the game. It will save lives, make roads less congested, and change the way billions of people move around the world.
So of all the companies we've talked about today, Nvidia definitely has the best 1 year chart. And in the past 1 year, they're up over 58% and they look like they're holding on pretty strong. Some of the pros for Nvidia include a narrow economic moat.
We changed it up on you.
We wish that was a wide economic moat, but we'll settle for narrow. They have, I think they take the prize with a 6,632% 10-year return, a 22% 5-year growth. We're familiar with their products. We have one of their video cards in our video editing PC. We love their focus on artificial intelligence and the progress that they're making there. The autonomous driving and their integration with companies like Uber and Tesla to power all the automation that happens in the autonomous driving. Awesome. And also we like the metaverse prospect that they have. They call it the Omniverse. And we like the position that NVIDIA is in especially, and we believe they'll be a key player in the metaverse in the future.
So if you look at the cons for NVIDIA, they have a 47% forward PE ratio. There's AMD and Intel. There's Apple and Microsoft CPUs that...
I think that's concerning that companies like Apple, Microsoft, even Alibaba are starting to develop their own CPUs. So in addition to some of the flashier companies that we've talked about investing in for the $1,000, we'd also recommend, and we do this in our larger portfolio, is to get some stability in your portfolio and also some income opportunities, flights to safety when there's volatility. So as we say that, here's a few things that we would also recommend you invest your $1,000 in. So this one is TLT, which is a 20+ year treasury bond ETF. And this seeks to track the investment results of an index composed of U.S. Treasury bonds with remaining maturities greater than 20 years.
And like Jared mentioned before, the highlights of this is that it's a flight to safety in times of market volatility. Their expense ratio is 0.15%, which is very low, and it has a total return of 6.61% since its inception.
Not bad. So it's not going to get you any huge gains, but it is nice to have in times of volatility.
Yeah.
And what we've seen in previous market crashes is when the market is crashing, people flock to this, and then this might have a 30% gain in that particular year. And for TLT's 1 year chart, you can see that it is pretty stable, especially compared to some of the other companies that we looked at. For example, this is down a little over 3% in a year. Another ETF that's similar to TLT is the corporate bond ETF. LQD. So this one is LQD. It's the iShares iBox investment grade corporate bond ETF. This tries to track the index of the investment grade corporate bonds, and it gives you a lot of diversity in that. So you basically get all the different corporate bonds all in one ETF.
Yeah, and the highlights here, again, it's a flight to safety in times of market volatility, provides stability and income, and its total return is 5.61 since its inception.
And now for LQD's chart, you can see that that's down over the past year a little over 7%. So again, that's a bigger drop than we saw in TLT, but it is relatively stable compared to some of the other companies like Alibaba with that, over 50% decline. And the last one is preferred stocks. And this is something that I don't hear many people talking about, but it's a great stability move for your portfolio. It's pretty much guaranteed money. And what we do is we actually invest in individual preferred stocks, which have a higher return rate than this. But because we're talking about how to easily invest $1,000, we thought it'd probably just be best to invest in this ETF. This is the ETF with the most assets under management for preferred stock ETFs. And this ticker symbol is PFF. And so this gives you a wide array of different preferred stocks all in one ETF.
And here with the highlights, you're exposed to U.S. preferred stocks. It provides a stability and competitive income, like we've talked about before, and its total return is at 4.84% since its inception.
And if you look at the chart on the right, you can see that overall this is down a little over or almost 5% in the last year. So pretty stable, but the nice thing is that it's constantly giving dividends at 4.8%, which again doesn't seem like much, but it is consistent, especially in a market downturn, to offset some of the losses you might take on for the other assets. All right, so now that we walked through all the different investments that you could make for $1,000, all the different companies that you could have, we wanted to show you if you had bought those, let's say a year ago. Granted, it's been kind of a rough past year, but it does invite buying opportunities for these companies. And so you can see from left to right, we started with the highest with Nvidia, Berkshire Hathaway having some of the highest gains, Nvidia almost up 60%.
Yeah.
And then you can see it sort of trails off after Google and Microsoft. You can see with Amazon, Adobe having some losses, and then it gets a little steeper with Trex, Disney, and then Alibaba bringing up the rear in the China market with, I think that's, what did you say, 58%?
55, 58, yeah.
In the last year. So, and that's the thing too, you want to have diversification, you want to have multiple investments, not just one, because some will go up, some will go down, but we do believe that in the long term, these companies will do really well.
So hold on.
Yeah, and this has been a particularly rough year, and there's been a lot of volatility, and the risk of rising interest rates hurts a lot of the growth companies like the ones especially on the right.
Thank you so much for watching and walking through how we would invest $1,000 if that's all we had. To help our channel grow, please do these 3 things right now. Make sure to give us a thumbs up, hit the notification bell, and subscribe to our channel below.
Check out this video where we break down our entire $1 million stock portfolio with you. And also watch our stock market investing playlist so that every penny you earn and save is invested wisely. Bye guys.